Wall Street's biggest banks reported mixed results this morning. JP Morgan Chase beat expectations, while Citigroup and Wells Fargo missed expectations. Checking the futures right now and the reaction to what we've seen on earnings. Dow Industrials expected to be up this morning about 20 points. Fractional move on the S&P 500, and the Nasdaq is up 8.25 points after reaching a record high on Nasdaq yesterday. Joining us right now to talk markets and investing is the chief investment strategist at Charles Schwab, Liz-Ann Sonders. Liz-Ann, good to see you this morning.
Good morning, Maria. Thanks for having me.
Your reaction to the results we saw this morning on the banks and overall the earnings picture from your standpoint?
So the fact that the banks actually had been fairly weak heading into this, and now you've got mixed earnings, that may send a little bit of a short-term troubling side for the market. Overall, so far, earnings, I mean, we have less than 10% of the S&P that's been reported, but up around 26, 27%, which is in line with first quarter. If you blend those actual estimate numbers with the estimates, you've got a little over 20% for the second quarter, which is great, a little bit down from the first quarter. The only issue I have is that the earnings growth rate is likely peaking, and that doesn't necessarily mean a death knell for stocks, but you do tend to have a little bit of a struggle when you are at that point of the growth rate peaking.
Liz-Ann, you talked about the growth rate peaking. I guess I come from the opposite standpoint. With the GDP continuing to grow, wages growing, do you think the economy is kind of stalled right now, or do you think it's going to take off and the stocks will continue to follow, or have we slightly peaked maybe in both stocks and or the economy?
Oh, I don't think we have any economic troubles in the near term. Just keep in mind, and I don't want this to come across as an Armageddon scenario here, but keep in mind when you look at past troughs and peaks in the stock market, at peaks in the stock market, the economic data historically has almost always looked extraordinarily good. In fact, in many cases, you're looking at peak type readings. And that's one of the reasons why in the past, at earnings growth rates of above 20%, the market has actually only had slightly positive returns. The best returns for the stock market have, believe it or not, have come when earnings are in the negative 10% to negative 20% area. And that's typically when you're coming out of a contractionary period. The market's a discounting mechanism. It looks ahead to that improvement in earnings. And it ties into what I often say, which is that when it comes to the relationship between economic and earnings fundamentals and the stock market, better or worse tends to matter more than good or bad. And investors sometimes focus on the absolute, when in fact it's rate of change, it's better or worse that tends to matter. So I just think a peaking in the earnings growth rate does have at least volatility implications for the market.
Well, Liz-Ann, it's Dagan McDowell. Is that the reason that we have Amazon, Facebook, Microsoft, and Google continuing to hit new all-time highs? Is that's the view of their earnings, or are they seen as being a little insulated from some of the trade tiffs that the United States is getting into?
So I think there is some perceived immunity to what's going on trade-wise. But quite frankly, too, if you look at the factors that have been driving the market, if you look inside in the internals and look at what have been the kind of winning characteristics, quite frankly, momentum has been one of those top characteristics. So I think just the wind that has been at the back of these companies pretty consistently for quite some time now continues to be a positive force, on top, of course, the strong fundamentals.
Oh, yeah, Liz-Ann, it's Kevin real quick. I saw in your note you're talking about how it's we're sort of late in this cycle here. We've seen actually a lot of defensive sectors have a bid up, whether it's utilities. Right. We've seen REITs do exceptionally well. They're yield sensitive. What is your take on that, especially in the rising interest rate environment?
So we actually have had an underperform on some of the more rate-sensitive areas like utilities and REITs and what used to be the telecom sector. And that was in an environment when investors were desperately searching for yield and really bid up those sectors to a point where, although they were still considered classic value sectors, they no longer offered value because they had been bid up by the yield chasers. Now I think that because rates have gone up, not just on the long end, but on the short end as well, and investors don't have to move out the risk spectrum for that yield, I think that's the environment that at least at times is going to put some bid under these defensive sectors. I don't think we're quite at the point where they're going to take over leadership in the market. In fact, I think if you started to see that, I think that would be a more ominous sign for the overall market. But I think that yield sensitivity and that need to pick up income can be found back on the fixed income side of things and not just on the equity side.
All right, we will leave it there. Liz Ann, good to see you this morning. Thanks so much.
Good to see you, too.
Liz
Thank
Ann
you.
Sonders, Charles Schwab.